Hi, I'm Ian from VenturePath, and I wanted to just give you a little overview as to what to expect from the investment process that you're about to embark on. So it's really, really important that we follow a structured process. This is something that we've delivered time and time again, and we know it works. Sometimes at this point we get a bit of resistance from founders or their boards or their non-execs or somebody who's raised money in a different capacity. Our absolute advice is trust our process. Right? We've been doing it for a long time. It's all we do day in, day out, and we know it works. So the investment process that we want you to be undertaking with us is to be getting really, really ready up front. And sometimes it feels like things are going to go a little bit slower before they can go faster. You'll be itching to go out and pitch to VCs, but maybe you haven't got everything quite ready yet. And by not getting it ready, it's going to cause your investment deal to either fall over or take longer than it should. So conversely, getting the work in up front really helps you set your best foot forward when you're going out to market to talk to those VCs. So things that will involve is an aspect of business readiness. We're going to do a check with you of how ready your business is from a growth perspective, looking at your growth in the last few months and quarter on quarter, year on year, so that we can really tell an exciting story about how your business is already growing quickly and in a way that's going to be attractive to a VC looking to back you for the next stage of growth. We're also going to look through any of the slightly cosmetic points. Have you got all of your ducks in a row? Have you got your business in a tidy position? What might that mean? That might mean that you've got outstanding debt on the balance sheet. Maybe that could be tidied up ahead of a funding round. It might mean that you've got some outstanding concerns, maybe some litigation going on, maybe some legal issues. Can they be resolved before you go out to market? Because they're otherwise going to create questions and concerns down further on in the process. Additionally, we're really going to help you think through the key numbers around your investor proposition. And what that typically looks like is, what's your entry valuation? So what's your valuation today? What's the likely exit valuation based on comparables, based on other businesses like yours that have been sold in real life at those kind of multiples? From that, it enables you to work out how much you can meaningfully raise. And against that raise figure, we're going to make sure you can answer the questions about what you're going to do with it tactically, how you're going to spend the money, but also perhaps more importantly, what it's going to do strategically for your business. So I'll come back to all of these points in a moment. And the fourth one of these is being the implied ROI. So what's in it for the VC that's backing you and why they would care. Their job is not to fund every business that comes in front of them. Their job is to pick winners that match their investment thesis and are going to deliver a return that's in line with what they've promised their investors, their limited partners in their funds. So there's quite a lot there to take in just around the investor proposition alone, and that's before we come on to documents. So going back to those, your entry valuation is usually going to be comprised of a few different moving parts, a few different elements. Your starting point may well be your last post-money valuation. So the post-money of your last round is the base case. Now, hopefully, you've achieved some more progress, some more momentum since then. And with that in mind, the thing to think about is how you can communicate that since whenever that last round happened, you put that last bit of funding to work and it's moved your business forward in these ways. Maybe you've now got more clients. You've moved away from a highly concentrated customer base to a more diverse customer base. Perhaps you've added in key hires, key non-execs, key advisors to the business that have all added to the value. And telling that story of the progress since your last base case, lowest valuation range really, is a key part. But then building on that, you also want to be able to talk about where you've got to now in terms of the proof points and how it's giving you the confidence in the forecast going forward. And by being able to talk about where you've got to with the business to date has given you the confidence for the future is part of the value improvement from your last round. And then ultimately, and this is perhaps just between us, you're going to get into an internal discussion about what level of dilution you're willing to accept. And that level of dilution has an impact on your entry valuation. Now, linking that entry valuation back to where you are today in terms of revenue gives you an implied revenue multiple today. And that's fine in isolation. The challenge is when your revenue multiple today is 15x and you're about to tell the VC that the exit valuations for businesses like yours based on real life comparable exits is 8 times. In which case you're asking your VC on day one to overpay. And they're going to spot that, right? So you're going to need to be able to tell us a story that links to facts that are proven and evidential in the market about exit valuation multiples of comparable businesses. There's a whole other session that we cover elsewhere around how to calculate these numbers, but in essence you do need to have been prepared to have done your homework, and not all of this information is in the public domain. So how do you address that? Maybe it's conversations with ex-team members of companies in your space that have been acquired. Maybe it's conversations with prospective hires that you know you're attracting away from companies that have been acquired, where you can begin to get some of that internal intelligence on what the multiples were, because often it isn't screamed about, it isn't published. So this all takes time, but in doing so you maybe get to a point where you can say businesses like ours have been acquired recently for revenue multiples equivalent to 8 to 10 times, 7 to 9 times, whatever your range is. And being able to back that up in detail with real life examples is really, really important, and builds confidence that a business like yours achieving its goals could also be acquired for those similar multiples. Now, another challenge there is that the multiple you're hoping for is going to be based on a number that you don't yet know, which is your year 5 revenue. So you're now back to your financial forecasts and being able to demonstrate, therefore, to your VC that if a business like ours are typically bought for 8 to 10 times, we think we're going to be in that range when we're acquired in 5 years' time. 8 to 10 times our revenue at that point gives us this exit valuation. Now you can add to that by talking through the likely acquirers, and ideally being able to reference that those likely acquirers are acquisitive, can identify that you solve a problem that they absolutely experience, and that they've got enough cash on the balance sheet for this kind of acquisition at the price you want to be feasible for them. And then once we've done those key numbers, so your year 5 revenue number, been backed up in your financial model, the entry valuation, the ask amount, how much you're raising, the likely exit valuation, from that, the VC is able to calculate their expected ROI. So where they're hoping to get to is the point that they can think, actually, if this business does sell for 200 million and we've got a 20% stake, it's 40 million. If we're putting 5 million in today, then we know we're getting 8 times our money. And giving them confidence on that kind of metric is a key part of the investor proposition that you really need to think through in advance. And as I say, there's a lot of homework there, and asking around and digging around to give confidence to those data points. Quick word of warning, don't use raise multiples. So the fact that another company raised at 20 times their current revenue is easily ignored by a VC, because you don't know that they didn't have a patent suite of 20 amazing patents, that they didn't have Mark Zuckerberg joining their board as chairman lined up. So there's stuff that happens behind the scenes in a raise that can inflate the multiple, whereas an exit multiple based on revenue is empirical. It is not easy for a VC to argue against. That is the number that a business like yours has recently been acquired for. So we touched on documents, and the documents that you need to get ready before you can go out to market is quite a comprehensive list. And again, we hear entrepreneurs push back on this to say, can't we just go out with a pitch deck? I raised my seed round just with a pitch deck. It's a series of conversations. I've raised money previously and it was much easier. I didn't have to go through this laborious process. That's right, and usually it's because the burden of proof gets higher over time. As your business is trading for longer, you've got more data points. As the funding you're asking for gets higher, you've got more data requests from your VC. Now, you could absolutely respond to these in a reactive manner as you go. So as you're in the negotiation, as your VC's getting warm, and they want a little bit more information on your go-to-market. They want to see an org chart of today and an org chart of the headcount in 12 months' time and 18 months' time. You could absolutely do it in a reactive way. But that is sadly the time that you're the most busy in the process. You're trying to close your round, you're in the middle of negotiations, you're in late stage meetings with a number of VCs hopefully, and then you're going away and producing documents that you basically could have produced in advance. So our strong encouragement is that you produce these documents in advance, And that enables you to be fully ready. A side benefit to doing it this way that we often see is that founders figure out stuff about their business when they're looking at it with the granularity of a business plan, a set of financial models, a pitch deck, and it's all coming together. They spot discrepancies, we spot discrepancies, they spot contradictions, and sometimes they identify that there are challenges in their business that they really need to go away and solve. So for example, they might highlight in the course of their review that their plan is to hire 5 salespeople and all 5 salespeople to work out perfectly. The reality is they look back at their business and realise that the last 5 people they hired, 2 of them didn't work out. Well, that has an impact then on the future hiring numbers and the amount of capital needed to fund that learning exercise as you're onboarding new sales hires. So little things like that get picked up can change fundamental points like your entry valuation, like the equity on offer, like the ask amount. Within this business plan and set of documents, we absolutely encourage a written business plan. So the ideal format for this, and we've got guidelines we can share, is a 20-page Word document. And yes, it's painful. Yes, it's laborious. Yes, you could argue whoever reads it. Ultimately, my answer to that is the investors that back you read it. In fact, so much so they rely on it in their investment agreement as one of the documents that you've disclosed to them that forms part of the disclosures and warranties bundle. So it absolutely is important to them, and it forms part of their belief, part of their investment case internally, and part of their contract with you. So business plan, 20-page Word document, not really more. Anything else should be annexed, put into an appendix, is a really useful starting point. Accompanying with that, you end up with a longer version and a shorter version of a pitch deck. So your short version might be used at an introductory meeting. It might even be used in place of a teaser, as an exec summary to qualify interest from a VC up front. So that is a short deck that can work as a standalone. You might have an extended version of that, maybe 20 slides, not more, that you would use for a face-to-face presentation where you can walk a VC through the business in a bit more detail. And again, we provide templates and guidance on all of these. But so now you're already aware that there's a 20-page Word document, there's a shorter version and a longer version of a pitch deck. And then the teaser, as I mentioned, could be a pitch deck, but it could also be a couple of sides of A4 which summarise the key highlights of your business. And that is really, again, used to qualify out VCs. That sounds like a strange thing to say, that we're creating a document that we can focus on getting VCs to say no quickly, but believe me, it's going to save you time and effort and energy and heartache of chasing VCs that can't invest in your business for structural reasons that they could have picked up on from a teaser. Are you an EIS-able business? Is your valuation in a range that they're able to back? Is your ticket size appropriate for them to lead, or would they need to follow? Would they be able to do a solus investment into you, or would they need to syndicate it? These are all technicalities that we can drive out the answers to in the very first point of contact by sharing that teaser. Beyond that, 2 more sets of documents to produce. One is your financial model. This should link historic financial trading data up to date as of last month, so bang up to date, with the next 36 months of monthly forecasts. These forecasts should cover your P&L, your cash flow, and a rolling balance sheet. And in doing that, what you're able to do is have a really, really clear set of numbers with the assumptions to support the growth from where you are now to where you hope to be. And then beyond that 3-year period, annualised figures for years 4 and 5. Why annualised? Because it's hard to predict the detail of month 60 and onwards, but you will have an idea at that point by what growth might look like on a top line and bottom line basis. So we just suggest years 4 and 5 as annual. Why would you even bother going out to year 5? We all know forecasting is a dark art and a difficult topic. Well, because in the investor proposition, you're talking about a 5-year exit horizon for most VCs to at least plan for that. Reality might be different, but having a plan that covers 5 years is quite important. In which case, having not given them your year 5 numbers means they can't calculate their expected ROI. If they can't calculate their expected ROI, they're going to either lowball it or pass on the opportunity generally. So giving them numbers that forecast out through 5 years, that show your business at a steady state of healthy growth at the point where it might be attractive to a potential acquirer is quite a key number to aim for. Within that financial model then, P&L, cash flow, balance sheet, set of assumptions, You might also want some additional notes if there's anything unusual, usually in the historics, something odd or as a one-off item that happened in the last 12 months, you might just want to explain away. And the final suite of documents is your data room. Now, if you thought the rest of what I've just been talking about was a bit boring, this is even worse. There's 16 files worth of data that your VC will be expected to review and analyse and understand. That will cover everything from all of the key due diligence topics: HR due diligence, operational, technical, legal, commercial, financial, data. All of those areas really drill down to the level of detail of specific documents, exact contracts, full details and disclosure. Now that, fortunately, doesn't get released to a VC until you're beyond term sheet, so that you're only really releasing that to one or two VCs that you're expecting to do the deal with. But it's boring work, right? And again, you don't want to be collating due diligence when you're in the middle of a process, because you're trying to close your funding round and you've still got a business to run. So doing these things upfront in advance is a healthy thing to do, and you'll thank us for it later. You might not thank us for it now because it's a painful and laborious task that feels like it's slowing you down, but actually it is getting you much more prepared to speak to VCs. And a last tip on this, because it maybe gives you the encouragement to go away and commit to doing this, or agreeing who's going to be doing it and delegating it and starting that process. A quick tip on this is that by getting all of this stuff in order, what you actually are able to do is shortcut some of the answers with VCs. So when they ask you a difficult question at a second or third stage meeting, you can say, great, I'm glad you've asked that. There is a slide on it. Let me flick forward and answer that question using this slide. There's a little bit more in the appendix. You'll find there's a chapter on this in the business plan. It's backed up by the assumptions in the financial model, and there's a folder in our data room to explain it in more detail. Now that does two things, right? One, it does answer the VC's question, but two, perhaps more importantly, it engenders confidence. So the VC now knows that you know exactly what you're talking about. You've got your hand on the detail, and all of the key points in the business, you're able to give them some comfort about. So hopefully that gives you a good overview of what's needed from the key documents, and also where that fits within the investor process generally. And then once all of that is ready, so you've got your business ready, you've thought through the funding requirements, and you've thought through the investor proposition, you've documented that in a full suite of documents: business plan, pitch decks, financial model, teaser, data room. You're now ready to go out to market. What does going out to market feel like when you're talking to VCs? Well, actually, the starting point for us will be a whole load of research with you on which of the VCs that your investor proposition fits with, based on your risk profile, your sector, your subsector, your growth aspiration, your target ROI. That enables us to shrink a list. We start with 1,000, 1,100 VCs on that list, and that's no use to you. You don't want 1,000 VCs. They're not all going to invest in you. It'll take you years and years to meet them all and close your round. So we try and shrink that down to a much smaller number, 30, 40 VCs that are tightly connected to your investor opportunity. They're the most likely investors to say yes. And from those initial investors, we will go out and have conversations with them on your behalf in the first instance, where we'll send them a teaser, speak to them, share a short paragraph, give them a call, have a coffee with them and raise it in passing that there's a business we're working with about to come to market. It's doing this well in this sector, and it's looking to raise this much for this kind of stake. And we will get quick answers from VCs. Why? Essentially, they rely on us for deal flow. We provide valuable pipeline for these funds, so they know not to mess us around. That is very different to the answer they give to an entrepreneur who they never want to offend. What if your business does become the rocket ship that everybody's hoping? They'll want to participate in your next round and your next round. So they don't ever want to say no and be the guys that give you a definitive, we couldn't back this business or we wouldn't back it at this stage. They like to keep it open and a bit vague. That's not very useful for you. So us acting in the capacity of an intermediary, we're able to get those quick and honest answers much faster, and that's useful because it's saving your time. They're not taking a meeting to get to know you. They're responding quickly to say, it's not one we could do at the moment, or it's not the right stage for our fund, or we might have a conflict. We'll go away and check that out before we agree to take in a meeting. Once that process of qualifying investors has begun, that will then see the start of the top of the funnel. And this funnel for you, if you think of it in 3 stages, the very top stage is quite a broad number of first stage meetings. Now, by sharing the business plan and financial model in advance of those meetings, you can progress the quality of those meetings. They move away from being what's your business all about into, I've learned a little bit about your business. I had a couple of questions that you might be able to help answer for me. And that then gets you moving more quickly in the process. Your second stage meetings will be less, right? So a load of those first stage meetings will say, do you know what? I thought this was one that we might be able to do, but I've decided there's something in it that isn't right for our fund. Now that doesn't mean there's something bad about your business. It doesn't mean your business isn't investable. And actually getting to those no's quickly is more helpful than going through a lengthy process and getting a no much later. Things that might be a no might be the use of funds is for something that the VC isn't sold on. So maybe you want to open in a new territory and they want you to focus on more domestic growth. Maybe you want to focus on domestic growth and they want you to be more international in your outlook. So that might just be a phasing issue. That might be that you're not the right VC for us right now, but when internationalization becomes our main priority in the approach to Series B, perhaps let's loop back then. So by getting rid of some of those first stage meetings, you get into better qualified second stage meetings. And second stage meetings move from the touchy-feely, getting to know you, learning a bit about your business, then pitching you how helpful their fund is, into some more of the details of the concerns we've got in this business are your churn rate or are the competitive landscape. And can you really give us some confidence around those points? Now, remembering that you've prepared all of this information in advance in your suite of documents gives you the confidence to answer their questions well and ace those second stage meetings. Second stage meetings are, in my mind, where basically the decision is really made. Do we want to proceed with this? Do we want to go further? Or should we leave our review there? The third stage meeting is then going to get into talking terms. And now thinking, this is the kind of business we'd like to invest in, but how did you arrive at your valuation? What is the likely exit horizon? Are there potential acquirers for this business, and why do you think those ones? And why do you think they'd pay these kind of multiples? Now again, linking that all to the comparable data sets of research you've done on businesses in your sector that have been successfully acquired, and having cross-referenced that with the potential acquirers you're naming and understanding a little bit about their strategy for growth, their acquisition plans, their balance sheet, all really helps tell that story with great confidence. Now, as an adjunct to those 3 key meetings, that get to know you first pitch, a deep dive, a real kind of analysis of the thorny issues in the business, and then a bit of a review of how a negotiation might work by third stage, you're probably going to get at least 2 spin-out meetings. These are perhaps not seen as important, but I would say all meetings with your VCs and their teams are important. The spin-out meetings typically will cover a walkthrough of pipeline. So think of it as their confidence that you're going to get from this year's number to next year's number. The period of scrutiny that you're under during due diligence means that they can assess your forecast and see how plausible they are, see if you're hitting your numbers. And also the feeling of that first year will give them confidence to share your investor proposition internally, to recommend it, to be the champion of it, to say, look, we absolutely believe these guys are going to achieve double their revenue this year because we've seen the pipeline and it looks good. That enables them to reserve judgment a little bit until they're able to reference that pipeline to some extent as well. So expect a sales pipeline review. That is a separate meeting. That's not purely part of the investment process, but it's always going to be in the investment decision stage. And a technical walkthrough. That might be a product demo, but it might also involve a proper technical assessment of the business. Think of it as a sort of light touch due diligence, really understanding the roadmap and what's coming next. Which you're already, in my language, hopefully picking up on the fact that this isn't just a you show. This is now going to involve your CTO, it's going to involve your chief revenue officer, your commercial director, whatever the titles are. It's going to involve meeting members of the team, and it's going to be something that you and any co-founders are going to be involved in at least 2 of those 3 top tier meetings. So there's quite a lot going on there, and then we multiply all of that by 10, 15 investors that you're going through to second or perhaps not third stage, but certainly second stage. Third stage, you might be doing this exercise with 3, 4, 5 VCs at once. So you can see how it eats a lot of time out of your diary in quite a concentrated period of time. So remember that and ensure that you're delegating properly back at the business so that there isn't a case that whilst you're in front of a VC, customers are not buying from you or customers aren't aren't retaining with you, they aren't staying with you, or that upselling isn't happening, or other key things aren't slipping, because what that tells a VC is that you're not very good at forecasting or delegating. So getting that right is all part of the confidence of that process. In conclusion, the very final stage is you've gone through all of that preparation, you've gone through the investor proposition with intricate detail, and you've ended up with the three-tiered funnel conversations with your VC and the ancillary meetings as well. You should now be at a stage that you're in receipt of heads of terms, offers essentially, and those heads of terms, we will work with you and your lawyers and any other advisors to help understand any moving parts, any of the aspects of the term sheet that could be improved, and ultimately getting the term sheets into the best possible state they can all be, so that you as a board, you as a management team, you as a cap table can assess the different options in front of you and choose the investors that are right for you. And maybe that's not always purely on the financial terms. Some of that might be on the relationship that you've begun to build up with them through the process, and perhaps even prior through earlier engagement through Venture Path. So those are the key things that you're going to be getting ready for. That's what we're going to be focusing on as we're taking you out to market. Don't be frustrated that we're not putting you in front of a VC on day one. If we did, you could guarantee it's going to create a slower process with more fails, because the VCs will pick up on the things that you should have got ready, and that's what we're going to start working on with you right now. Thank you.